Tech earnings in full swing. Alphabet reporting a revenue of over $22 billion in its third quarter report. Shares surging 5% in after-hours trading, well above $1,000, an all-time high. Google's ad business continued to be the company's juggernaut with over $24 billion in revenue. I spoke with CFO Ruth Porat earlier. We talked about their relationship with the EU, M&A, and growing political pressures. She also called out the other bets segment with helping to strengthen this particular quarter. For more, I want to get to Ben Legg, CEO of Adparlor and former COO of Google Europe. So, Ben, let's start with traffic acquisition costs rising to $5.5 billion. This is the money that Google pays to its distribution partners like Apple to keep apps like YouTube front and center on the phone. When I asked Ruth Porat about traffic acquisition costs, she said we have a very healthy mobile search business. It's growing substantially. The increase reflects a change in partner agreements and the ongoing shift to mobile, which carries higher traffic acquisition costs. We have a strong position in a growing area. How much of a concern is this?
It depends on how you define concern, but the reality is a lot of mobile companies, their products are increasingly commoditized, and they're looking for, what's the maximum they can squeeze out of those sort of revenue shares from Google. So I think it will go up. There's probably other areas of traffic acquisition costs too, where there's a lot of upward pressure for Google in areas like display revenue shares as well. So I think it's something that, to a large extent, we just have to get used to, as there will be a trend upwards. Clearly, Google will do everything they can to slow that growth, but I don't think it's going to reverse anytime soon.
So when you look at the numbers, it seems like most things are otherwise going in the right direction. What are the main highlights, the main standouts to you?
Obviously the sort of overall growth beat expectations. They haven't broken out, or at least I haven't seen if they've broken out where that's come from, but my bet is a lot of that will be coming from YouTube. YouTube is doing very well. I know there have been lots of questions lately around, has YouTube recovered from the whole brand safety scare earlier in the year? Certainly all the evidence I've seen suggests they are. We've seen meaningful price increases. We've seen pretty much almost every single advertiser back on YouTube. So that's certainly a highlight. Beyond that, I think just its overall health in the ads business. Now, clearly there's a lot of other bets out there. The revenue's growing, but the losses are continuing. So there's no real, at least what I've seen so far, no real standout success. But clearly revenue growth of something like 50% year on year in the other bets is a good sign. But to start being meaningfully profitable and contribute to the bottom line, we'll need a lot more growth yet.
Other bets revenue now totaling $3.4 billion, and actually CapEx spending on those bets has dropped dramatically year over year. They spent $324 million on other bets last year, same time this year, that's $77 million. Ruth Porat told me that's mainly because they're spending less on Google Fiber right now. They're really focusing on developing the technology before expanding it. And she also spoke specifically about how they decide where to continue to invest in other bets. She said, what we're looking to do with other bets is create valuable businesses over the longer term. What we do is a multi-year financial model, establish business, technology, and financial milestones. It's really a multi-year look at creating what we believe are multi-year opportunities. And she singled out Waymo, the self-driving car unit, and she said they're very pleased with progress they've made when it comes to safety, when it comes to ways that self-driving cars can help cities, but there's also this sense that they're thinning out their investments in other bets. Ben, what do you make of that?
I think they have to. They have to be disciplined around this. The reality is, for Google or for Alphabet to actually build something that will meaningfully change their results or change the world, they need to only be focusing on bets that can generate at least, say, $10 billion in revenue and meaningful profits. Now, very few bets that any company can make have a reasonable chance of building a $10, $20, $30 billion business. So they really do need to think through what are the things that can really change the world, that will really generate a lot of revenue, and that Alphabet has a meaningful, a good chance of being one of the winners. And clearly driverless cars is a massive opportunity. And obviously the auto industry is massive, and it seems like Alphabet is ahead of the pack, or at least one of the front runners in that area. So I think they're absolutely right to focus there. There's probably a lot of other bets within Alphabet where they say this is going to be too small, or we're too far behind, or there's too much competition.
Now, got to ask you about what's going on in Europe, since you're the former CEO of Google Europe. Let's talk a little bit about this record EU fine that they're facing. Google has proposed a remedy whereby rival shopping sites would compete for space at the top of the search results pages. Ruth Porat told me that they've worked hard on this remedy. They feel good about it, but it's too early to tell whether they'll come to an agreement with the EU. How big an impact do you think this could ultimately have on the business in Europe?
Well, if their proposal is accepted, meaning that, let's say, Google product search would be allowed to compete with, let's say, Amazon or any other e-commerce site within the Google results, theoretically not too much impact at all. Because in essence, the way Google algorithms work is they prioritize Google product search roughly based on how much consumers like it and click on it anyway. So that would just be a creation of Chinese walls, probably a little bit less intuitive reading of each other's products between Google search and Google product search, but it would be a very soft landing for Google. If Europe were to say Google can't do product search, just allow other advertisers to compete and stop offering that format, that could be pretty bad for Google. So Google's revenue from retail-related searches is probably something like 20 to 30% of all its search revenue. Now, clearly, the money wouldn't go away because people would still search on Google, but you might find that over time, more and more consumers start their searches with, say, Amazon or other e-commerce sites instead of with Google, and that's when the revenue goes away. So in the short term, as long as people start their shopping journey with Google, Google's in a pretty solid place. But if they start saying, all Google does is take me to other sites and I might as well go straight to the other sites, Google starts losing meaningful revenue. So it's a much bigger risk if they can't operate some form of Google product search, even if they have to create Chinese walls between them.
All right, and I mentioned you were the CEO of Google Europe and the COO of Google
I'll take
Europe.
The
still, yes, indeed. Still very valuable to have your perspective. Ben Legg, CEO now of Adparlor. Ben, as always, great to have you here on the show. Now, staying with Alphabet, Waymo, the self-driving car unit, is expanding its winter testing. Next week, the autonomous vehicles will be testing again in Michigan and attempt to see how the cars will respond in the mix of wintry conditions like snow, sleet, and ice. Michigan is the 6th state where the self-driving car project will test autonomous vehicles. Coming up, while many social media platforms are trying to find a way to stay ahead of fake news, one company is ahead of the mark. How Snapchat is succeeding where Facebook, Twitter, and Google failed. This is Bloomberg.